Hi, welcome to Finance 367's pre-lecture video covering the capital asset pricing model, often commonly known as the CAPM. My name is Professor Kevin Ewan, and in this lecture series, I'll be giving you an overview of one of the most important concepts and equations that we'll encounter in this course. And I hope that by the end of this lecture video, that you'll walk away with a greater appreciation of why this is the case. So let's go ahead and get started. I think it's worth illustrating, again, the trade-off between expected return and risk, which we proxy for as volatility and which we measure with as standard deviation. Okay, and we've seen this curve before. This curve is known as the efficient frontier, and each of the points on this bullet-shaped curve corresponds to a specific level of weights corresponding to a portfolio. So what do I mean by that? Let's go a little more specific. Let's say I consider this dot here, this red dot here, and this might be corresponding with a weight of, let's say, of Apple stock of 70% and weights in Facebook stock, of 30%. Okay, that's possible. If I have in my universe the availability to buy Apple stock or Facebook stock, I just simply construct weights of 70 and 30. And with those weights, I have an associated average or expected return of the portfolio, which is computed as simply the weighted average of Apple stock and Facebook stock. So 70% times the return of Apple plus 30% times the return of Facebook. That'll give me the expected return of my portfolio. Now, I can also get the variance of the portfolio, which is much more complicated and won't be covered in this series, but we're going to measure that using, essentially, we're going to take the square root of the variance of the portfolio, and which is the standard deviation, and we're going to proxy that as the risk of our portfolio. Okay, so this red dot here corresponds to, say, a 70% weight, a 30% weight in Facebook, and we're given with that an associated level of average return and an associated level of standard deviation or risk. And I can pick another dot over here, and that might correspond to, I don't know, 60-40 with Facebook or Apple, or even 50-50. The point is I can vary the level of weights in my eligible universe of assets and plot out the expected return of that portfolio, as well as the standard deviation of that portfolio. And we're going to plot the standard deviation over here on the x-axis and the expected return on the y-axis. Now, it's worth asking, why do we actually see this bullet-shaped curve? And I've kind of hand-waved away the variance term here, but the variance term is a little bit more complicated because it actually takes into consideration the correlation between the two assets. In other words, when Apple stock goes up, what does that tend to do to Facebook stock? Right? So if we have correlated assets, we're going to introduce a more complicated variance term. And that's what makes this frontier bullet shaped. All right. That's just kind of a side mathematical technicality. And I can also introduce a risk-free asset into this plot over here. Right. And the risk-free asset is going to have an associate. You can think of these as T-bills. And the risk-free asset is going to have an associated expected return given by this level F. And notice that it's going to have a level of standard deviation of 0. And that's by definition because we're assuming that the risk-free asset has no risk. So of course, the level of risk as proxied by the standard deviation is going to be 0. Okay. So now we understand what this bullet-shaped curve is plotting. It's plotting all the combination of weights that are available, as well as the associated expected return and standard deviation. It's worth asking ourselves, where would a rational person want to stand on this frontier? What do I mean by that? More specifically, let's say, let me change this color to blue. Let's say we have a level of risk given by, I don't know, 3% standard deviation. Where would this investor, a rational investor, want to be? Well, they would move up onto this curve and say, do I want an expected return down here? Or do I want an expected return all the way up here? And the answer is obvious. They want to be on the upper portion of this bullet-shaped curve. And we tend to call that that portion the efficient frontier. Okay, because for every level of standard deviation, an investor is going to want to be on this upper shade of the curve. Okay, and you might be thinking, why did we introduce T-bills or the risk-free asset onto this curve? Like, we didn't just do it for fun, right? And the reason we did this is because now what we can say is, let's now consider a mixture between the risk-free asset and any hypothetical portfolio. Let's call it portfolio. Let's look at portfolio A. Okay, so I can draw a line connecting the risk-free asset and portfolio A. And this is a linear combination of all the possibilities that I have available to me, right? So in other words, let's pick a midpoint right here. And this midpoint, what I'm saying is I want 50% of this new portfolio, 50% of my assets in the risk-free asset, and 50% of my assets in this risky asset, which of course already comprises of its own weights, right? So let's say, in other words, portfolio A corresponds to, I don't know, 20% in Apple and 80% in Facebook, okay? So that's what point A corresponds to. And by picking this dashed line here, what I'm saying is I want 50% of this portfolio and 50% of T-bills, okay? And so that's what this ray corresponds to. Now, the question becomes, can I do even better? Okay, I have this portfolio A and I've connected it with the risk-free asset. Can I do any better? And the answer is yes, because if you notice, what I can do is I can shift over and consider another portfolio P. And what I do is I can compare now, I can draw a line between the risk-free asset and portfolio P. And again, these are all the possibilities that are available to me. And when I ask the question, I just take a step back of what do I mean by do better? Well, it's worth looking at the slope of this curve, right? So what is the slope of this curve? The slope of this curve is going to be, again, rise over run. So we're going to take the return of a particular portfolio. The rise is minus the risk-free rate. And the run is the standard deviation of this portfolio. Okay, so when I ask, can we do any better? What I'm asking more directly is, can we improve this ratio or this slope? And this ratio has a very specific name. It's known as the Sharpe ratio. It's named after Bill Sharpe, who invented this and actually won the Nobel Prize. But essentially the question is, we want to be at a point in which this curve is, this line, is tangent to this efficient frontier. And the reason we want to be at this particular portfolio, we have a specific name for this portfolio, we call this the tangency portfolio, is because we can't do any better, right? There exists only one portfolio that you can mix with T-bills such that you can never do better in terms of this risk-reward trade-off of the Sharpe ratio, right? Because I can't consider a portfolio here X because that's not even in my efficient frontier. So I don't even talk about it, right? I'm only considering portfolios along this bullet-shaped curve because, again, those are the combinations that are available to me in this universe, okay? And as long as we go with the assumption that you like expected returns, right, which I guess is a safe assumption, right? People like more money, and you dislike risk, right? You want to have less risk, which again is a safe assumption, then everyone would want to choose this tangency portfolio, right? There won't be another line that can get me a higher Sharpe ratio. And that's a remarkable insight of portfolio theory, because what this is saying essentially is, regardless of differences in preferences that we might have, as long as we satisfy the assumption of liking expected returns and disliking risk, then everyone will want to hold this tangency portfolio. Now, again, I didn't say what portion of this tangency portfolio do we want to hold, right? Maybe you want to hold 50% of your assets in this tangency portfolio and 50% of your assets in T-bills. That's going to depend on your risk preferences, right? If you think about like a hedge fund, maybe a hedge fund wants to be all the way out here, right? In other words, they're over leveraging and they have more of the tangency portfolio than is afforded to them. So they're going to borrow at the risk-free rate and go over to this point. Or let's say they want to have 100% of their assets in the tangency portfolio. Or let's say that you have a very risk-averse investor and they're risk-averse, so they want to have more of the risk-free rate. The point is, doesn't matter, based on risk preferences, that's going to dictate how much of the tangency portfolio you want. But under this theory that we've just talked about, we all are going to agree on the mixture of this tangency portfolio. Okay, so again, where on this line you fall will depend on your specific preferences, but we're all going to agree that the tangency portfolio is something that we want to hold. Okay, so let me just draw on this curve. I think it's often helpful to draw a new curve because there's a lot of things going on. Sorry at my attempt of drawing straight lines. Okay, so this is a curve that we had before, right? All I drew were the axes. So again, this is the standard deviation of the portfolio, and this is the average return of the portfolio. Okay, and again, we can have a bullet-shaped curve right there, each of them corresponding to different weights of the risky asset. And again, we have our risk-free rate down here. And we talked about this tangency portfolio just now, and we're actually going to give it, we're still going to call it P for now, but I'm going to draw the line that we saw in the previous slide, and we're going to call this P. Because now I want to say, okay, we agree that we all want to hold this tangency portfolio, but we disagree on how much of the portion in which we want to hold. Do we want more of the risk-free asset or do we want more of the risky asset? But besides the point, we know that the slope of this curve, okay, so the slope of this curve is rise over run. So we take the return of the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. That's the slope of this curve, okay? And given 2 points and the slope of a curve, we can derive the equation of this line. And the equation of this line is, so suppose we take a hypothetical return I. What's the equation of this line? We have the y-intercept given by the risk-free rate, okay? We have the slope, which is given by this Sharpe ratio, portfolio minus the risk-free rate divided by the standard deviation of the portfolio. And we also need that x variable, right? Which we'll call essentially sigma I. Okay, so we can rewrite this equation, not really rewrite, but yeah, let's rewrite it. So risk-free rate plus, sorry, I need to erase this portion here. Let's kill this here. Okay, we can rewrite this equation as sigma I over sigma P times RP minus RF. Okay, so what this equation is saying is, if I want to price the expected return of a particular asset, what I do is I have a base return, which is the risk-free rate, plus what is this over here? The risk of the portfolio of the tangency portfolio minus the risk-free rate. That's essentially some sort of risk premium. Okay, and we're going to multiply this risk premium by some factor, which we won't label right now, but we'll just call it some factor. Okay, so we've taken this step. We all agree that we want to hold the tangency portfolio. In what proportion, we don't know, but we know that we want to hold the tangency portfolio. We're going to draw the tangency line between the risk-free rate and that tangency portfolio. And we're going to just simply write the equation of the line, which is what I've done over here. Okay, and if we were to take the, let's plug in, I don't know, let's consider the tangency portfolio, what would we get? Well, we can take this equation. We would get the risk-free rate plus sigma I, I would sub in the standard deviation of the tangency portfolio divided by the tangency portfolio, RP minus RF, right? This is clearly 1. These would cancel out and you would get the return of the tangency portfolio, which makes sense, right? Because if I want the return of the tangency portfolio, I get the return of the tangency portfolio. And the reason we're going through this equation is because now I can say to myself, what is the price of any asset along this capital allocation line, right? What is the return of a particular asset if I fall on this line? And that's given by this equation over here. All I need to know is the risk-free rate. I need to know the risk premium, which is the return of the tangency portfolio minus the risk-free rate. And I need to know this factor. And this factor, if we look a little deeper now at this factor, it's the ratio behind the standard deviation of the thing I want to price relative to the standard deviation of the tangency portfolio. And if my asset is riskier, that is, if the standard deviation of I is higher, then I'm going to get a higher expected return, which is intuitive, right? Risk reward, the higher the risk, the higher the return. So that's an insight that we can glean from here. Now, the question is how much higher? Well, I need sigma I to be sufficiently higher than the standard deviation or the risk of the tangency portfolio to be compensated above and beyond what the risk premium commands. Okay, so what I'm showing over here is just more mathematically and graphically how we price the return of any security I that lies on this line. All right, and that's a key point that has to lie on this tangency line. Okay, so we've kind of talked about tangency portfolio P. The next question is, okay, if that's true, what does the portfolio P have to be? Right? We've kind of just talked about this hypothetical tangency portfolio P, but we haven't really talked about what exactly that portfolio is. And it turns out that, and again, this is a remarkable insight, that it turns out that that portfolio is going to be all the equities in the marketplace held in proportion to their market value. Okay, let's say that one more time. It's going to be the return of every single asset in the marketplace where we weight those returns based on their proportion to market value. And that's a beautiful result. And it's worth taking a step back of asking ourselves, well, why does that have to be the case? And it's simply a supply and demand equilibrium argument, right? Because if everyone holds, we agree that if everyone holds portfolio P, that's the demand side, okay? And we know that the total demand of the economy has to equal the total supply of the economy. And the total supply in this framework is all the assets in this universe, right? So if everyone holds portfolio P, when you aggregate the demand for portfolio P and you add up everyone's demand for P, everyone's weights are going to be identical, okay? And if you aggregate everyone's demand for holdings P, that has to equate to all the equities that are available in this universe, okay? So in other words, there's only so much GM stock that's out there, right? And if we want to understand what's GM's share in this total portfolio P, well, we simply just take GM's market share divided by the total market share that's out there. And that's going to be the weight of a stock like GM, right? And this is a shockingly simple but powerful result, again, due to Bill Sharp. And they said to themselves, well, if everyone's holding portfolio P, let's call this the market portfolio. Okay, let's put a specific name on it. Let's call it the market portfolio. And we can replace this over here with M, the market portfolio. And we can give it more details. We can call this actually the market risk premium, right? So it's the return of the overall market relative to the risk-free rate. So this is going to be the market risk premium. And now what we're saying is, if we want to price the expected return of asset I on this efficient tangency line, we simply take the risk-free rate, we multiply the market risk premium by the ratio of standard deviations and the standard deviation of the market, right? We just call this the market. The market. Okay, so we're going to proxy. So the question is, what is the market portfolio, right? And that kind of goes into debates like, is the S&P 500 a good proxy for the market portfolio? Well, you're looking at the 500 biggest stocks. So if they move, the market's going to move as well. Maybe you might want to look at the Russell 3000, right? Or the NASDAQ. There's a whole host of proxies that people can look at when trying to understand how we price the market portfolio. Okay, so we already talked about that the expected return of an efficient portfolio, again, on that line, is equal to the risk-free rate, right? So just rewriting the equation, is equal to the risk-free rate plus the ratio of the standard deviation of asset I relative to the standard deviation of the market portfolio, we'll just put an M going forward, times the market risk premium, right? We can also sometimes call this the excess return of the market, right? Or the market risk premium, okay? And what it's saying is, again, you have a base return, and what you expect for your portfolio is this base return, right? Some minimum value, the risk-free rate, plus the market excess return times how risky you are relative to the market, right? And if you hold the same as the market, right? If you let this guy here be RM, this cancels out and we're back to the return of the market portfolio. If you hold more risk than the market, right? So if sigma I is bigger than sigma M, right? Your expected return right, relative to the risk-free rate should be bigger than, well, I don't know how much bigger, but it should be bigger than the return of the market relative to portfolio, relative to the risk-free rate. Okay, and let's say that your asset has no risk, right? So if your asset has no risk, then sigma I is equal to 0, right? So we plug in 0 over here. 0 times anything is 0. So that means that your expected return is equal to the risk-free rate. And that makes sense, right? Because there's no risk over here. So your return should be equal to the risk-free rate. Now, the tangent portfolio is, again, extremely powerful because regardless of risk aversion, right? I don't care how scared person A is in this room or watching this video, or person B is, doesn't matter how scared you are of the markets, we can all agree of the combination of this tangency portfolio, right? And what we'll disagree on is how much of it you want to hold relative to risk-free rates. And again, finding the tangency portfolio is quite challenging, right? Because first of all, we don't know how to proxy for, I don't want to say that finding the tangency portfolio is challenging, but if we were to do mean variance analysis, right, of, let's say, N assets in the economy, that immediately becomes very challenging, right? Because if we looked in our first example, we were actually only looking at 2 stocks, Apple and Facebook, right? That's manageable. Maybe 3 stocks you can kind of do. And again, I mentioned this variance term is actually quite complicated if we were to write it out because there's a correlation term. But imagine we were to write, let's say there's 1,000 securities or 10 or 2,000 securities out in the market. Well, you can imagine things would get a little out of hand, right? If we wanted to do this mean variance analysis and compute all the correlations of all the assets. And that's what we mean by this N by N covariance matrix, right? The variance term would need to consider the correlations between every single security in the market. And so we've kind of developed a shortcut here where if we wanted to price the return of security I, we can simply use this equation if it lies on that tangency line and price the security, right? And we talked about the name of this portfolio that we're calling this the market portfolio. Okay, and so going back to this figure now, again, all we've talked about, if you notice, we've only talked about pricing securities on this tangency portfolio line, right? But what if I wanted to price any other asset, right? It's not necessarily the case that I have an asset that lies perfectly on this tangency line. So does that mean I can't price things, right? Well, what actually happened was the capital asset pricing model, which was developed by Bill Sharp and among others, is a centerpiece of modern finance because it allows me, we won't derive the capital asset pricing model, okay? Because it's a little bit involved and I think it's outside the scope of this course, but the capital asset pricing model extends what we talked about in this line to any security, okay? So any security I, whether or not it lies on this tangency portfolio, we're able to price using the capital asset pricing model. We use this line to kind of motivate the intuition of why an asset would be priced in this form of a base asset times a risk premium times some factor. But we're going to take a step back and say, we want to be a little bit more general and price any assets that don't necessarily live on this tangency line. And that's what the CAPM gives us, right? It's based on portfolio theory by Harry Markowitz and Bill Sharp, as well as John Littner back in the 60s, where they did some derivation, right, that we won't necessarily go into too much detail. If you really want to talk about it, I'm happy to go through it, the logic with you in office hours. But it was a centerpiece of an equation that allowed us to price any security I, regardless of whether or not it was on that tangency line, right? And we're going to call that multiplier, right? So it's going to have some similar form. We're going to essentially have a base return. We're also going to have the market portfolio minus the risk-free rate. So again, it's still the same flavor as what we saw on the tangency line, but instead of multiplying it by the standard deviation of security I relative to the standard deviation of portfolio, the market portfolio, we're going to multiply it by this metric called beta. Okay, and beta, more specifically, oops, sorry about that, is equal to the covariance of the market's return with security I divided by the variance of the market. Okay, so this is the definition of beta. And again, there's a lot of math that they went through to come up with this equation, but you'll notice that it actually has a really similar flavor to what we saw prior, right? Where we had a different factor. The only difference here is actually the factor, because prior factor, if you remember, was sigma I relative to sigma M, and we're replacing it with beta. But the intuition stays the same. The price of the return of any security, expected return of security I, is equal to some base return, some bare minimum, plus beta times the market risk premium. Okay, and the numerator, if we look now a little deeper into this beta equation, the numerator is the covariance between the market and the asset. Okay, and we think about positive assets that have positive covariance, means that when the market goes up, this security tends to go up. And if we have negative covariance, when the market goes up, this asset tends to go down. And the variance of the market, as you know, is how spread out is the market's return over a particular time period. Now, beta is the right measure in the sense that it determines what this multiplier is going to be, right? We can also use this equation in corporate finance, and when we're trying to define the cost of capital, right? So you might, if you take a corporate finance class, you'll also see this CAPM equation showing up as well. Okay, and so we can price the expected return of an asset as well as the cost of capital, the weighted average cost of capital. I think it's the acronym they usually use is WACC, weighted average cost of capital, using the capital asset pricing model. And of course, the weighted cost of capital, it has implications in corporate finance as well as capital budgeting, right? Because that gives you the appropriate discount rates in your net present value calculations. Again, don't worry about it for this course at the moment, for this lecture at the moment, but I'm trying to give you the connections of where you might see this equation pop up throughout your career in finance. Okay, and again, they won the Nobel Prize in economics in 1990. So the CAPM, the capital asset pricing model, we kind of went through this logic already, but the risky asset that they're demanding is this tangency portfolio. And we know, again, a supply and demand equilibrium argument, that the total supply of assets in the total economy has to be given by this market portfolio. Because if everyone demands a portfolio, if everyone has the same demand for a particular portfolio, that portfolio has to be all the assets in the economy. And we're going to call that the market portfolio. And based on equilibrium arguments, which we did not derive, we get the capital asset pricing model equation. Okay. So just to summarize a little bit more, the capital asset pricing model is a statement that the market portfolio is mean variance efficient, right? In other words, what this is saying is this market portfolio lies on that tangency point over here, right? So this market portfolio is the tangency portfolio. And because it's the tangency portfolio, it's also mean variant efficient because it lies on this efficient frontier, right? Sorry, imagine they connected, right? But again, now we know how to price assets that don't necessarily have to be on the mean variance efficient curve, right? If we, prior to that, we had to only price assets along this line, but now we're able to price any assets using the capital asset pricing model. It has a lot of profound implications, right? I began this pre-lecture series in the introduction saying that this would be one of the most important equations we'll be encountering in this course. And the reason for that is because it turns out that it has profound implications. The market portfolio is the optimal investment choice for all mean variance optimizing investors. Mean variance optimizing investor means that we believe that investors like expected returns and they dislike variance. And beta with respect to the market portfolio is a proper or correct measure of risk of any investment. Now, it doesn't have to lie on this line in particular. It can be down here. We use the CAPM to price that asset using the beta measure. Okay, so the expected return on all assets follow beta pricing with respect to the market portfolio, right? So what this is saying is you take the beta measure and you multiply it by the market portfolio's excess return. And now we want to talk a little bit about the assumptions that went into this derivation of the capital asset pricing model, because again, it is a model, and like any model, you have to talk about the assumptions that we make when we're deriving this equation. So we assume that all investors take asset prices as given. What that means is people are small enough so that they can't influence market prices, right? Whether or not you believe this assumption is a different story, because obviously in the real world, you do have big players that don't necessarily take asset prices as given, and they can actually move prices in the direction that they want. We're abstracting away from those guys. All investors care about are returns traded over one period, right? There are extensions of the capital asset pricing model when you talk about longer period, but that's outside the scope of this course, and we're only talking about a one period return. Okay, so there are also no non-traded assets. Investors can borrow or lend at the given risk-free rate, right? So if investors want to over leverage, if they want to borrow more, that the rate that they borrow at is the risk-free rate, or in our example, treasury bills. And investors pay no taxes or transactions costs. This is clearly false. And all investors are mean variance optimizers, right? This is what we talked about earlier, where investors care about two parameters. They care about expected returns, which they like, and they dislike risk as given by standard deviation. And all investors perceive the same means, variance, and covariance for returns. And what I mean by that is, if everyone's looking at Apple stock, we can all agree of the return on Apple stock, right? There won't be any like confusions where you think that the return of Apple stock is 8% and I think it's 6%. We all have to somewhat agree of the means that we see out in the world, the average returns, the variances of these returns, as well as the covariances. Because if we disagreed, then of course we disagree on the tangency portfolio, and we'd also disagree on everything else, right? So this is kind of just a little more of a unifying statement where we're all on the same page in terms of the assets that we see out in the economy. Okay, so this is again kind of reiterating that we all look at the same mean variance mean standard deviation diagram. We all want to hold the efficient part of the frontier, right? This is what we were talking about earlier, where if you have a frontier, it makes no sense to be down here, right? Because for every standard deviation point, I can always find a higher return point, expected return and standard deviation. So we kind of disregard this portion and only focus on the upper portion, which we call efficient. Okay, and since all mean variance efficient portfolios combine the riskless asset with a fixed portfolio risky assets, again, the market portfolio, we refer to this as the separation property, right? Separation in the sense that we first all agree on the mixture of the market portfolio, which is the market cap weighted average of every asset in the economy. But what we disagree on is how much of that do we want relative to the risk-free asset? And that's why this is called the separation property, right? It's kind of essentially it's broken up into two steps. The first step is, what is the mixture of risky assets, right? That we all have to agree on, and how much of it do you want? How much do you want? And that we can all potentially disagree on. And again, the derivation of the capital asset pricing model is based on supply equaling demand in asset markets. And as a result, we showed that the market portfolio is mean variance efficient. Okay. And if the CAPM holds, right, if we believe in that simple equation, it's worth writing this a number of times because of how important it is. If we believe in this equation, then we don't have to draw out the efficient frontier for every single portfolio, because again, if we have two assets, it's doable. 3, maybe 50, it gets a little out of hand, right? Comparing all those covariant matrices. And that's why it's saying there's no need to perform mean variance analysis, because if I want the expected return now, all I need to know is the risk-free rate, which I can look up in T-bills, either in the newspaper or Wall Street Journal. I can look up the markets portfolio, assuming the S&P 500 or the NASDAQ. And again, I have this. What I don't have is beta. Okay, again, what is beta? Beta is the covariance of the asset, relative to the market divided by the variance of the market. The beta term actually has a very unique interpretation in econometrics, where beta is actually going to be estimated from data. Okay, and we won't necessarily go through this in detail in this pre-lecture series, but in class we definitely will. But essentially, if you have enough data on the return of a stock, and you have enough data on the return of the market relative to the risk-free rate, you can run a simple linear time series regression to back out your beta. Okay, and with your beta, you can price out any assets. Okay, so what this is saying is we can look at other proxies for the market, right? So these are all proxies that we can use to compute or measure the market's return. Okay. And so again, because the market portfolio is the tangency portfolio, the beta pricing holds with respect to the market portfolio. And this is the capital asset pricing model over here. Okay, I think it's worth pausing just for a second to talk about different scenarios. So let's say that beta is equal to 1. Okay, so what does that mean? Well, I plug in 1 over here, and what I immediately get is that the expected return, if you notice, this equation looks a little different, and the only difference is they just swung the risk-free rate over here to the left-hand side, so there's nothing weird going on here. Okay, so if I were to do that, I can take the expected return of my asset is equal to the risk-free rate, plus, I said beta is equal to 1, right? So beta is equal to 1 is equal to the expected return of the market minus the risk-free rate. And of course, the risk-free rates cancel. So at beta equals 1, I get the return of exactly the market. Okay, and that makes sense because beta equals 1 means that you're perfectly correlated with the market because you are the market, right? And if beta is equal to 0, what this is saying is that the expected return is equal to the risk-free rate, right? Plus 0 times anything is obviously 0, you get the risk-free rate, right? So beta is equal to 0 means you're neither here nor there, you're just at the treasury bill at the risk-free rate. Let's talk about when beta is negative. If beta is negative, what we get is the expected return of the market minus the risk-free rate, I'll just leave this here on the left-hand side now, is equal to beta times the expected return of the market minus the risk-free rate. Sorry, there's actually need parentheses matter here. Okay, market minus the risk-free rate. Okay, so if beta is actually negative, it turns out that the expected return is going to be less than the market's portfolio. Now let's think about that for a second. Okay, so if beta is less than 0, or it can even be less than 1, to be honest. If it's less than 0, less than 1, the expected return of your asset, the risk premium of your asset is less than the market. That's a little weird, right? So what this is saying is these kind of negative correlation betas are going to be less risky, right? Because it's so less risky that it's actually turning negative. And the idea behind this is because negative beta assets, or beta less than 1, or low beta assets are essentially assets that don't move around with the market, right? So if beta essentially it moves opposite to the market, and that turns out to be a safe asset. And the reason why it's a safer asset, because you're able to hedge yourself. Okay, so what I mean by that is when the market does very poorly, this asset actually does really well. So this is actually going to be a hedged asset, which is the reason why it's perceived to be relatively safe, and that's why the return is going to be less than what would command if beta is greater. Okay, so you can think of beta as your measure of risk. If beta is very high, you move with the market, right? And that's a risky thing to have as an investor because when the market tanks, this asset also tanks, okay? And this, again, goes through the regression that we don't have to worry about this for now. The alphas are equal to 0. Okay, so the capital asset pricing model, again, we've really hammered it home. We've talked about this in many forms, but essentially it's the risk premium of a particular asset is going to be equal to the risk premium on the market times this beta term, which we've defined as the covariance. Okay, and again, so the covariance is a measure of how does this particular asset move the market. If it moves with the market, it's pretty risky because when the market does bad, it does bad. And if it's negative, well, the return's going to be lower because it's safer. Why is it safer? Because when the market tanks, this asset does well because they move in opposite directions. Okay, and again, the capital asset pricing equates prices for all assets and portfolios, including the market portfolio itself. I think it's worth, having built this technology now, I think it's worth taking it out for a spin, right? Because we have these equations, and if we don't do anything with it, what are we even doing, right? So let's write out the capital asset pricing model is equal, actually, I want to keep it consistent, is equal to beta risk-free rate plus beta times the market's risk premium. Okay, so let's say that the beta of Netflix is equal to 1.28. How did I go at 1.28? Again, we're going to have to use time series regression to estimate this, but for now, let's take our beta of Netflix as given. Okay, let's say that the risk-free rate is equal to 1%. All right, just hypothetical. Could be higher, could be lower. Let's say that the market's return is about 10%, right? And that's going to be true sometimes and not other years, but this is an average statement, right? So we're saying the average return of the market is about 10%. What is the expected return of Netflix stock? Well, what I can do is I can just simply plug it in, right? I can get my 1% as the risk-free rate, right? Plug that in, plus my beta of 1.28 times, let's say actually this is 2. That's a little more reasonable. Then the market risk premium is going to be simply 10 minus 2, 8%. Okay, so this is 1%, 8 times 1.28 is 10.24, and that's going to be equal to 11.24%. So the capital asset pricing model predicts that the expected return of Netflix is going to be 11.24%. Okay, is it always going to be 11.24%? Absolutely not, right? Because like any other model, the CAPM is a model and it's subject to misspecifications. Maybe this beta was incorrectly measured, right? That's also possible. But it gives us a framework, at least, how to think about and how to price assets that we see out in the economy, using what we see out in the real world, the market portfolio and the risk-free rate. It also offers a really strong and powerful intuition that when you're given a particular asset, the higher the risk, we know that higher risk means higher returns, right? We kind of talked about that since day one, and it kind of resonates with us. But now we've actually quantified a little bit more about what we mean by risk. And what we mean by risk is the beta of a particular asset. And what do we mean by a beta of a particular asset? The beta is how does this asset move with the market, right? If it moves very strongly with the market, that's a risky asset, and investors need to be compensated with that in the form of higher expected returns. If the beta of the asset is negative, that is, it moves opposite to the market, well, then investors are actually, they enjoy this asset because it's kind of a hedge and it's going to offer a lower level of expected return because it's less risky. Okay, so I hope this gave you a good idea of the capital asset pricing model. In class, we'll go through a few more examples of applying this. And as you'll see in your corporate finance classes, and when it comes to capital budgeting, this weighted average cost of capital, or this discount rate, or the expected return, is used when computing net present value of future cash flows or net future values of projects, right? Because this is a fair measure of the cost of capital or the expected return. Okay, thank you for tuning in to this pre-lecture series, and I hope that this gave you a better understanding of how we use the capital asset pricing model. Thanks.